So continuing with chapter 9, when you become a corporation or when a company becomes a corporation, they have to file paperwork with the government. And that those legal papers are called articles of incorporation. And then once the government approves this company to become a corporation, they call that a charter. And the next slide, this slide gets into the heart and soul of chapter 9. So chapter 9 is all about a merchandising business. And what a merchandising business does is they have stuff in their store called merchandise that they sell then to customers. To get that merchandise into that store, you have to buy it from someone else. And so the companies that supply those items, that merchandise to a store is called a vendor. And a lot of times when you buy from a vendor to put stuff into your store or online to sell to customers, you pay for that at a later date and you don't pay for it up front. In chapters 1 through 8, we call that accounts payable. So when you are doing a merchandising business and you're going to have multiple vendors, it's easier for the paperwork and for the bookkeeping to put all of those vendors in their own ledger. And we call that a subsidiary ledger. Sometimes it's also called a subledger. So in chapter 9, we're going to be dealing with the accounts payable ledger, which is the people that we owe money to. Those vendors that we buy the merchandise to put into our stores are accounts payable vendors, and they go in the accounts payable ledger. We still have an account in the general ledger called accounts payable, and we call that the controlling account. So in chapter 9, we're going to be dealing with the accounts payable ledger, which is why it's a little bit bigger on the page. In chapter 10, we'll deal with the accounts receivable ledger. These are the 6 vendors that we will be doing business with throughout this unit. This slide gives you a visual of what I just explained. So over here on the left, we have a list of each of those vendors that we are doing business with and a balance of what we owe them. These all together make up our accounts payable ledger. Then over here on the right-hand side, we show that we still have that accounts payable account in the general ledger. And the balance of the accounts payable account in the general ledger should equal the total of all the vendors' balances added together in the accounts payable ledger. Accounts payable is a liability. We know that liabilities lay on the right-hand side of the accounting equation because credit means right. And so accounts payable increases with a credit and decreases with a debit, and the accounts payable ledger will follow that same rule. So this shows you what our ledger forms look like. So down here on the bottom in the green is our general ledger for accounts payable. We have a debit and credit column for the transactions, and we have a debit and credit column for the balance. Accounts payable typically always only has a credit balance, but we have debit and credit columns because when you make a payment, that is a debit and decreases what we owe them. So in our accounts payable ledger, the yellow form up here, we don't have as many columns. We simply have the debit and credit columns for the transaction, because when you buy merchandise on account, it's going to be a credit because it's going to go up with the credit. And when we make a payment, it's going to be a debit. So we only have one column for the balance because you should never have a debit balance in an accounts payable vendor account. It should only be a credit balance or zero. And so this just shows you the different parts of that ledger form.